of the transaction, means the value of a payment or a stream of payments that is to be received in the future. It refers to a technique used to determine the present value PV of a future payment or a sequence of cash flows that will be received in the future. The amount of the payment calculated today and the amount will be received in future. The time value of money is one of its underlying fundamentals, and it is relevant in analyzing the present value of future cash flows. So businesses use various discounting techniques like net present value, NPV, NPV, and IRR is the internal rate of return to estimate the profitability of potential investments. So discounting is the, in one word, if we say the discounting is the value of a present payment, and but it will be received in future. So another word is the discount rate. Discount rates are the rates of return used to assess the present value of future receipts. Discount rates and their type can vary depending on variables, most notably the duration and the level of uncertainty. While low discount rates are less susceptible to uncertainty, and large discount rates carry a higher risk. So we have to be in a medium ranges. Discount rates make it possible for investors and businesses to assess the risk involved in an investment. Different types of discounting rate depending on the nature and intended uses. Multiple discount rates are applied to the investments. Number one, sometimes people use to calculate the different investment criteria. Number one is the weighted average cost of capital, WSCC. The WSCC discount rate calculates the net present value of a business. So net present value is another important term. And which is done by the weighted average cost of capital. Okay, the cost of equity. The cost of equity is the rate of return of a business provides to its equity investors. It is employed to determine a company's equity value. Number three is the cost of debt. The interest rate of a business pays on its debt or to its bondholders. It is utilized in the appraisal of fixed income assets. So one is the cost of equity, and that is the rate of return a business provides to its equity investors. Say, for example, you are the investors. You invest some money, and the rate of return value coming from the business, which is sometimes known as the cost of equity. On the opposite side, the cost of debt, the interest rate a business pays to its debt. The amount of money to be paid for the different, the condition, or is it a debt or to its bondholders. This is the cost of debt. Number four is the hurdle rate. The hurdle rate is the lowest allowable rate of return for a project investments. This is the lowest allowable rate of return. Okay. This is the marginal value, rate of return. And this is the hurdle rate. You cannot go beyond this or under this value. Risk-free rate. Another five. Number one is the rate of return provided by an investment with no risk is known as the risk-free rate. Additional or more risk is not acceptable until the possible rate of return is higher than the risk-free rate. Investors set the risk-free rate as the minimal return they expect from any investment. So obviously you have to ensure the risk-free rate so that the risk always so that you can do it. And what are the advantages and disadvantages of the discounting? The advantages is it considers the time value of money. The discounting principle operates because the money received today is worth more than the money that comes in the future. Okay, in simplest terms, it is the transformation of a future value into an equivalent value that is received now. For organizations, the discount rate method facilitates decision making. It aids in not only comparing projects of same size, but also in determining whether a given investment is profitable or not. It's a good term. If you have this amount of discounting value, you can make a decision that the investment is profitable or not. But it has some disadvantage. Certain techniques cannot be used to compare projects of various sizes. For example, NPV is not a percentage. NPV means the net present value is not a percentage, but an absolute number. As a result, a project of a larger scale would certainly have a higher NPV than one of a smaller size. If you have a different kind of company, smaller size company has a smaller NPV, larger scale company will have a larger NPV. So the smaller project's returns might exceed its investment, but the NPV value might be lower because the smaller projects maybe there is a smaller risk, so the return will be higher than the cost or the investment, but the total net present value is not so much high. So the technique depends on significant data projections, including revenue and expenses. So it can give you some projections, okay, not the accurate value. So this is little disadvantages. Now let's talk about the difference between the discounting and compounding. Okay.
I have a question.
Yes.
What do we mean by future value here?
Future.
Future value.
Future value means the here you can see. Okay, let me talk here. Maybe you'll understand here. Okay. Future, maybe you have some product and it has a today's value and it has also tomorrow's value. So another one is there are 2 days, today and tomorrow. Okay, the value is one in your hand. So discounting will tell you it converts the future value into a present value. That is the present value of a future sum. Means the value that will be received in tomorrow, thus now you are calculating today. So this future value will be calculated, will be analyzed in the present time. This is the discounting. So it converts the future value into present value, that is the present value of a future sum. But on the other hand, compounding, it converts the present value to future value. Means the future value of present money. Okay, that's completely different. So present value of future money is the discounting. Future value of present money is the compounding. That is the different things. So is okay, please. Okay, have you got it?
Sir, can you explain it with an example?
Okay, and next slide, maybe I'll give you example. The result of the computation indicates what we should invest today in order to receive the desired amount tomorrow, indicated by applying a discount rate to a future sum. And in compounding, the result indicates that we will receive in future time from an investment made today. And in discounting, discount rates are used and compound interest rates are applied. So compounding and discounting, they are strategies. They are the strategies used to determine the value of money at various points in time. In order to determine the value of money in the future, the compounding method is applied in order to determine the value of money in future. On the other hand, discounting is a method for determining the present value of future money. Future money's calculation will be back calculated and you will get the in present time. The future money, what will become, and this one now you are calculating and you will get in. And compounding is the money that will be calculated in future and will be received in future based on the today's investment. Let's have an example. I will give you one example is here also. Okay. After 2 slide example is here. Just wait, please. Another one is the interest, the cost of money. We know that money left in a savings account earns interest so that the balance over time is higher than the sum of the deposits. Everybody we know there is some interest in our regular banking system. Because if you put some money in the bank, they will do some business and the amount of profit will be distributed to you. And this amount of extra money will be added to your deposited money. And the amount of extra money is the interest. We know that borrowing to buy a car means repaying an amount over time, including the interest. Thus, the amount paid is more than the amount borrowed. The cost of money is established and measured by an interest rate, we know, a percentage that is periodically applied and added to an amount or to varying amounts of money over a specific length of time. When money is borrowed, the interest paid is the charge to the borrower for the use of the lender's property. When money is loaned or invested, the interest earned in the lender's again for providing a good to another person. So interest that may be defined as the cost of having money available for use. Let's talk about some elements of the transaction involving interest. Many types of transactions involve interest. If you borrow some money, interest will come. Invest in some money or purchase in machinery or credit. Certain elements are common to all of these types of transactions. These elements are the initial amount of money invested or borrowed in a transaction is called the principal. This is the P, principal. The amount of money that is first invested or borrowed is known as the principal, P. The interest rate measures the cost or price of money and is expressed as a percentage per period of time. Number 2 is the interest rate. There will be some rate. This rate will be applied for a certain period, maybe 1 year, 2 year, or 3 years. If the rate is equal, is a simple interest. If the rate is not equal, it will be the compound interest, we know. Another term is the period of time called the interest period, or which is known as small n, determines how frequently interest is calculated. Note that even though the length of time of an interest period can vary, interest rates are frequently quoted in terms of an annual percentage rate. Okay, so usually we calculate and we know the amount of interest rate been calculated annually. So annual interest rate, and in that case, the interest period is 1 year. A specific length of time marks the duration of the transaction and thereby establishes a certain number of interest periods Maybe this amount of a small interest period will be extended to for 1, 2 year, 3 year, 4 year, 5 years. You have an interest rate 1 year, an interest period 1 year. Now the question is how the amount will be based on the principal after 10 years. So number of capital N is in that case is 10 years. So one is the small n is the interest period. Interest has been calculated based on that year, means the 1 year or 2 year, 1 year. Basically, it's a 1 year. Small n is 1 year. And that's why it is known as the annual interest, annual percentage rate. And the capital N is the total number of periods that you have to calculate for the total amount of money, including interest. Number 5, a plan for receipts or disbursements yields a particular cash flow pattern over a specific length of time. For example, we might have a series of equal monthly payments that repay a loan. Or sometimes we have to disbursements the money. Number 6, a future amount of money F results from the cumulative effects of the interest rate over a number of interest periods. So, say for example, please initially you invested capital P and it has some interest rate, interest period and total number of period, and finally you will get the future money capital F. So very carefully minded that P is the initial investment principal P, F is the future money. So as we have discussed about the discounting and compounding, so sometime one will be P capital P, sometime one will be capital F. So that's one I will talk to in here. Okay. So if you carefully understand this one, then you will understand how it is calculated and what will be the discounted, what will be the compounding. First of all, the simple interest, the first scheme considers interest earned on only the principal amount during each interest period. In other words, the interest earned during each interest period does not earn additional interest in the remaining periods, even if you do not withdraw the earned interest. So in general, for a deposit of P dollars means the principal at a simple interest rate small I for total number of n periods, the total earned interest I, capital I, would be IP into capital N. Okay, IP into capital N. So small I is the interest rate, P is the initial investment, and total earned interest, very carefully minded, that's the total capital N is being applied. Okay. So this is the total interest money, earned interest, total interest. So now we have to add this total interest with the principal, and this will be the future value. So the total amount available at the end of n periods, as it is a future value, capital F would be used. Capital F equal to P plus I. Then in I, you have small I, P, capital N. So you can take a common capital P. So in that case, capital F equal to capital P bracket 1 plus small I N. Simple interest is commonly used with on loans or bonds. Very simple calculation. So here, if you have the principal and if you have interest rate and total amount of period, then you can calculate the future value by the simple interest formula. Compound interest, yeah, this is another interest period. Under a compound interest scheme, the interest earned in each period is calculated based on the total amount at the end of previous period. This total amount includes the original principal plus the accumulated interest that has been left in the account. In this case, you are in fact increasing the deposit amount by the amount of interest earned. In general, if you deposited or invested P dollars, means the capital or principal at an interest rate small I, you would have P plus IP. So P1 plus I dollars at the end of 1 interest period. If the entire amount, principal interest, were reinvested, very carefully mind it, this amount will be reinvested in the next year. Okay. At the same rate I for another period, you would have at the end of the second period, you will see P. This is the first value. You can see here first year value. And this first year value will be reinvested at the same interest rate, small I. So this is the value will be in similar condition, in analogy to that value. Okay. So this one we can get P common, 1 plus I. So P into 1 plus I square. Continuing, we see that the balance after period 3. This is the 2. There's a P into 1 plus I square. 3 P into 1 plus I to the power 3. This interest earned in process repeats, and after n periods, the total accumulated value F will grow to capital F equal to P1 plus I to the power n. To the power n. So engineering economic analysis uses the compound interest scheme exclusively as it is most frequently practiced in the real world. Okay. So this one we have to calculate, and everybody always try to use this formula is the compound interest. Okay, let's have an example. Example of simple and compound interest. Simple versus compound interest. Very carefully mind it. Suppose you deposit $1,000 in a bank savings account that pays interest at a rate of 8% per year. Assume that you do not withdraw the interest earned at the end of each period, but instead let it accumulate. You will not withdraw the money from the bank after 1 year. Rather you just keep it in the bank, and every year the bank will give you interest at the same 8% rate. How much would you have at the end of 3 years with the simple interest formula? Number 2, how much would you have at the end of year 3 with compound interest formula? Okay. Now we have the equation given P equal to $1,000. Capital N means the total accumulated year is the 3 years, and interest rate is 8% per year. We have to find out the capital F. In right side also same. In simple interest formula using the equation 2.2, we calculate F. Let's see the previous slide. 2.2. 2.2 is this one, capital F equal to P into 1 plus I into capital N. This is the value here, P into 1 plus I into capital N. So this value is $1,240 after 3 years. Okay, after 3 years, this one in simple way, if you put the value in the equation, then you will get the value of future value after 3 years. This value will be after 3 years. And this value has come from your $1,000 value. The remaining one are the interest. Add it in your principal. Let's see. Okay. Year by year, the interest occurs as shown. End of year, beginning balance, interest earned, end in balance. In the first year, started from 0. So you invested $1,000 beginning balance capital. And in the first year, you will get the value is I into P. I into P means what? 0.08 into 1,000 is the $80. Let's see here. Yeah, I into P. This is the I into P. Okay. So this is the first year just interest calculated as $80. So principal value, interest value is the ending balance after first year. Okay. In the first year. Okay. Ending balance. So this ending balance will come to the beginning balance in the second year. Okay. 1080. And interestingly, as the simple interest, every time the earned interest will be same, P into I. Nothing else. P into I every time, as it is simple interest formula. So every time it will be added as 80 with that value. It is now the ending balance after second year. And this ending balance will come as the beginning balance in the third year. And the 80 is the IP. Okay. I is the 0.08, P is the 1000. So it's 80. So now we are getting the total future value after 3 years is 1240. This is the same value, 1240, same value. So this is in one step, you are getting the value, and every step, if you do year by year, this same value will come. Okay. Now let's see the compound interest. Applying the equation 2.3 to our 3-year 8% cases, we formula is capital F equal to P into 1 plus I to the power 3 here. Yeah. F equal to P into 1 plus I to the power 3 in the third year. Okay. So the value is 1259.71. The total interest earned is 259.71 as the initial investment is 1000, which is 119.71 more than the accumulated on the simple interest. Okay. If you see the difference here, that's only 19. So simple interest, the value was 1240. Here, the 1259.71. So the 19.71. If you subtract from here, this one from here, so more than accumulation, we can keep track of the interest occurring process more precisely as follows. Let's see. End of year is the first year, beginning balance 1000, interest earned IP. So 0.08 into 1000 is 80. So the ending balance is 1080. This one will come in the beginning balance in the second year. Now this is the P, very important. This is the P into 0.08. Okay, and now the interest earned is completely different if you compare with here, as it is a compound. So now these two value added this one, and similarly like this one. So 1259.71. So comments at the end of first year, you would have a total of 1.1080 minus $1,080 in that interest. In fact, at the beginning of the second year, you would be depositing 1080 rather than 1000. Thus, at the end of the second year, interest earned is 86.40 and so on. This is equivalent amount you would be depositing at the beginning of the third year. This one with the beginning principal, the total balance value would be this one at the end of third year. So this is the comments, and this is what about you can get the future value based on the present value, okay, and based on the interest and the total interest period. Okay, I think you get the point. Now the interest formula for single cash flows, compound amount factor. Okay, let's see. Given a present sum P, okay, P previously we also talked about the P was the deposited money or the principal money, present value, invested for n interest periods at the interest rate I. What sum will have accumulated at the end of the n periods? You probably notice right away that this description matches the case we first encountered in describing compound interest. To solve for f in the future sum, you use equation 2.3. Capital F equal to P into 1 plus I to the power n. Because of its origin in the compound interest calculation, the factor I plus 1 plus I to the power n is known as the compound amount factor. So this is little important. Compound amount factor. What do you mean by compound amount factor? The factor 1 plus I to the power n is known as the compound amount factor. Like the concept of equivalence, this factor is one of the foundations of engineering economic analysis. This is very important for these courses. Given this factor, all other important interest formula can be derived. Okay, so the main factor is 1 plus I to the power capital N. The process of finding f is often called the compounding process, as the future value we are going to find. The cash flow transaction is illustrated in figure 2.7. This is given in the right side. Note the time scale convention. The first period begins at n equal to 0. Let's see n equal to 0. So this 0 value you will see here. And ends at n equal to 1. So if a calculator is handy, it is easy to enough to calculate 1 plus I to the power n directly. Okay. So to specify how the interest tables are to be used, we may also express. Okay, let's talk later on. So please come to this boundary value, boundary line. Single payment compound amount factor, growth factor is sometimes known as the growth factor. Okay. So what do you know? Capital F equal to P into 1 plus I to the power n means what? At the time of the n equal to small n equal to 0, this P value is invested. Carefully mind it. It is negative value because if you invest something at the beginning of the year, this amount will be go out from your pocket. Is investment. Investment is here negative value. And if you invest it, after some time, you will get the future value, F value. And this is the total number of n, after total number of n years, that you will get the future value from the initial P value. Let's talk about the given I equal to 10%. Interest rate here only 10%. Total n equal to 8 years. Initial value invested is 2000. Okay. Now, you can easily calculate capital F by putting the value in this equation. 2000 in bracket 1 plus 0.08. 0.1 to the power 8. This value you can easily calculate by your calculator. This value will come that one. Okay. Means the first line and the first line is same. So P is 2000 bracket 1 plus I is 0.10 to the power capital N is 8. Okay. If you want to buy the F value is the compounding process. Okay. Sometimes we have to find out the P process, P value. Okay. So here one new term has come. You can see F value equal to P. Very important. P bracket. Okay. Bracket. Now, so if you want to read this sentence, you have to say about the find F. Okay. Find F given that find F given P, I and N. Okay. So capital F by P means what? Find F given P, I and N. What is F? F is the future value we have to find out. The initial one is the unknown value F, but these all value will be known value. So that's why find F given PIN. Okay, PIN. So this second line, if you come here, you'll see capital F equal to P value is the 2000 bracket start. Find F given P, comma, I is the 10%, comma, capital N is the 8%. Okay. So this F by P, I will talk you later on. Now, if you want to use this very simple formula, And if it is a very big term, you will not do it in a simple calculator. That's why we have to do it in other way. So that's why it is given here. So okay. Then we have to use a interest table, and to specify how the interest tables are to be used, we may also express that factor in a functional notation. This is the factor in functional notation. Find f given p, I, n, which is read as find f given p, I, and n. This factor is known as the single payment compound amount factor or growth factor. When we incorporate the table factor into the formula is expressed as follows. This one, same value. So now, I will show you one example. This very easy example, how it is coming by this way. I will show you in the next slide. Okay. This example is 2.4, that the book I have given you, very simple books. This problem is based on the compound amount factor in the chapter of interest formula for single cash flows. Example is very simple. Example 2.4, single amounts, compound amount factor is the growth factor. Find f given p, I, and n. So the question is, if you had $1,000 now and invested it at 7% interest compounded amount annually, how much would it be worth in 8 years? After 8 years, how much it will be? So this dissecting the problem, given P equal to $1,000, I equal to 7% per year, and capital N equal to 8 years, find future compounding value F. Methodology, we have some different methodology. Method 1, using a calculator, is very simple, that you can use the calculator and you can do it, no problem. Answer will be okay, you will get the marks. So you can simply use a calculator to evaluate the 1 plus I to the power capital N term, and financial calculators are pre-programmed to solve most future value problems. So if you have a financial calculators, you can do it by pressing the value P, I, and N, then you will get the future value. Okay, number 2 method, sometimes you have to use this method because sometimes it's very difficult term will be here and you cannot get easily. That's why you have to use the compound interest tables. Compound interest tables. The interest tables can be used to locate the compound amount factor for, I equal to 7% and capital N equal to 8 years. The number you get can be substituted into the equation. Compound interest tables are included in Appendix B of this book. Well, I'll go to this book right now. Now, before that, please use this method we are getting. So if you have this value, if you know the equation, we can write capital F equal to P in bracket. Find F given P is 1000. But you have to write F by P here to find out the value from the table. Comma, I is the 7%, capital N is the 8%. Okay. Now why you are getting the value 1.7182? Let's see in the table. Okay. But mind it that 7%, 8. 7% is the I value, 8 is the number of N. And we are getting F by P, not P by F. Okay. Let me open the book, please, very shortly. Wait. I'm just okay. This book I've given you. Okay. Appendix. Where is the appendix? I'm searching. Okay, is appendix. I'll give you this interest factor for discrete compounding. Okay, appendix B. Let's make it big. Now it's clear. Okay. So if you see this kind of table in the question, first of all, you have to understand 0.25% is the interest rate. As it is a single payment or equal payment series or gradient series, we are talking about the single payment. Okay. Compound amount factor, find F given P, I, and N. This is we have to find out the capital F. But if you go in reverse way, present worth factor means what? Find P given F. F will be given in that cases. I will be given and it will be given. Okay. Now our problem is the 7% and 8 years. Okay. Now is the 7%. Please go to the 7%. Is a 0.75%, 1%, 1.25%, 1.5%, and 1.75. We have to go more. 3%, 6%. Yes, this is the 7%. 7%, and our capital N is 8. So this table we have to use 7%, and the total is the 8. You can see 8. Okay, 8. You can see this value. So, okay, this F by P I N value is 1.7182. You don't need to use I. You don't need to use capital N for multiplying, for power factoring, and so on and so on. Just you will get the value of F value in a case of compound amount factor corresponding to the 7% I value and capital N is 8, 1.7182. And if it is a present worth value, then you will get this one. Similarly, okay, let's please remember it, 1.7182. I am going to again the slide. Okay, 1.7182, 1.7182. Now I am sharing. Maybe you're okay here. So this F by P given 7% 8, this value is in bracket. Inside the bracket, you can see 1.7182, exactly the same value that we noticed. And thus you will multiply this one, 1000 into that one. This is the answer, capital F. No need to use the calculator, no need to use the power, no need to use the other complicated things here. You just will see what is the interest rate and what is the total N. Then you go to the table and you will take out the value from the table and put it here and to multiply with the P value. By this way, we can get the capital F. This amount is essentially identical to the value obtained by direct evaluation of the single cash flow compound amount factor. The slight deviation, little deviated here, is due to the rounding differences. Rounding differences in the first cases, you have to do some rounding because this is to the power 8. The calculator will give you a very long, very big value. You have to round it, and this is the accurate value. Okay, and this is the future value calculation, compound amount factor. Now, and another, use a computer. You can also use a computer to find out the future value using the financial software program for solving compound interest problems are available for use with personal computer. As summarized in the back cover, many spreadsheet programs such as Excel also provide financial functions to evaluate various interest formulas. Okay. And also similar things will come here. So you don't need to know this one because in exam, in this two value method, you can use. Okay. And okay, now let's talk about the present worth factor. Previously, I talked about the future value. Now is the present worth factor. Finding the present worth of a future sum is simply the reverse of compounding. It's known as the discounting. Okay. If you want to calculate the present value based on the future value will be given, but you have to find out the present value. This is the discount. Previously, I did the present value is given. We have to find out the future value. This is the compounding. Okay. So very similar. And you see, we know here f equal to p into 1 plus I to the power capital N. What will be the p equal to f into 1 by 1 plus I to the power capital N. But if you want to write it in a simplified form, what will be the below? Present below p equal to, find the p value given f. That's why f into, in bracket, find p given f, I and n will be given. Very simple in the opposite side. The factor 1 by 1 plus I to the power n is known as the single payment present worth factor. Previously, it was single payment compound worth factor or growth factor. Now is the present worth factor. And is designated this one. Tables have been constructed for p by f factors and for various values of I and n. The interest rate I and the p by f factor are also referred to as the discount rate or the discounting factor respectively. So here you can see f will be given. F initial value I've given. We have to find out the p value. Very simple. Very similar. I equal to 12% is given and equal to 5 years. Future value is, you can see the 1000. Future value is given 1000. We have to find out the p value, means that by using the discounting process. So what is the formula? P equal to given f bracket p by f I n. So p equal to, in calculator also you can use, no problem, but you can also use the table. So 1000 is the future value bracket given, find p given f 12% and 5. This bracketed value is 0.567. Okay, 0.567. And maybe I just describe this one in the table. The second column is the p by f value. I think you got the point. And now let's have an example. 2.5 single amount, find fee given P, F, I, N. A zero coupon bond is a popular variation on the bond theme for some investors. What should be the price of an 8-year zero coupon bond with a face value of 1000 if similar non-zero coupon bonds are yielding 6% annual interest? So what would be, okay, and 1000 is the future value, I is given 6% and equal to 8. We have to find out the p value. So easily you can use the calculator, this one, or you can use the interest table. Here is the, you can see the f p equal to f bracket p by f I into capital N. So 1000 into this value will come from the table, interest table. This is 0.6274 is equals to 627.40. Again, you could also use a financial calculator or computer to find the present worth with Excel. Okay, similar. So previously it was the compounding value. Now it is a present discounting value. This one you can see 1000 is given, and you have to go back, and initially it will be negative value because it is the invested value. Invested value must be negative. It will be go out from your pocket. And after then 8 years, you will get the profit and the value will be good, will be high. Okay, here. I have taken it here. You can understand here. Okay. Let's see 0.25% and percentage, and this is the value. You can see the compound amount factor. Find f given p I n. Here find p given f I n. Side by side is given, no problem. Okay. Very simple. Okay. And this one is very another simple things because we have to find out the time or interest. Every formula we have f equal to p into 1 plus h to the power n or p equal to f 1 plus h to the power minus n. Every time, sometime it is the future f value given p value I and n, or sometime we have to find out the p value given f value I and n. But another, beside these two values, f and p, we have another I value find out. We have sometime you will be asked to find out the capital N value similar. So another one example is here. Example 2.6. Suppose you buy a share of a stock at $10 and sell it for $20. So $10 is the present value, sell it 20 value, F value is 20. Your profit is thus 10 because 20 minus 10. If that happens within a year, your rate of return is an impressive 100%. The 10 by 10, 100%. If it takes 5 years, so capital N is the 5 years, what is the rate of return on your investment? So I, we have to find out, I. In many ways, you can find out f equal to p into 1 plus I to the power n. By using the calculator also you can do it. You can see $10 invested, negative value. First year, second year, third year, fourth year, fifth year, it has become $20. We have to find out the number of I. So we can go to the interest table as well as, or you can find out by calculator, I equal to 14.87%. Here, okay? Either you have this p value, this f value, this p value, this n value, then you can easily calculate the percentage, okay, in a different way. And here, this is the value you can see, very important, f equal to p into 1 plus I to the power 5. So this means what? If you calculate it, 2 equal to 0, 0 cancel, 2 equal to 1 plus I to the power 5. This is what? Find f, p, I, and 5. So you can take the f value is 2 and n equal to 5, then you can get easily I value. Okay. We look across the n equal to 5 row under the column until you can locate the value of 2. This value is approximately 15% interest stable. Okay. So f by p equal to 15%, p equal to 2.0114. Exactly it is 2. So it's very similar. So the interest rate at 2 is 10% grows to at over 5 years is very close to 15%. This procedure will be very tedious for fractional interest rates or when n is not a whole number, as you may have to approximate the solution by linear interpolation. So maybe you have to use the interpolation. Interpolation means the formula that you have studied in the geometry. Y minus y1 divided by y1 minus y2 equal to x minus x1 divided by x1 minus x2. So by this way, we can find out the I value. And there is another examples. Find n. Here is a n value we have to find out. P given, F given, I given here. P 3000, F 6000, I 12%. What is the capital N? So 3000 is invested, 6000 is the future value, and I is the 12% interest rate. But how much here? Okay, what is the number of year? We have to kind of easily that the P F equal to this one by calculator you can easily find out, or F by P 12% N. And by this way, you can also go to the table, and in this way, you can get the number of year. Okay. Here here. Either you can get the value of percentage or you can get this value because P and F given. This is F value, this is P value given. These two value you know, and for this interest rate, you can get easily the N value. Okay, N value. Or N value is given, P value given, F value given, then you have to go another table to match with the interest rate. So for unknown value, in each and every time, you have to use the table, or you can use the calculator. So this is another term, is the cost of capital. So previously it was the discounting and compounding. Okay. Compounded is the future value, discounted is the present value calculation. Now, let's talk about the cost of capital. Cost of capital is a company's calculation of the minimum return that would be necessary in order to justify undertaking a capital budgeting project such as building a new factory. The term cost of capital is used by analysts and investors, but it is always an evaluation of whether a projected decision can be justified by its cost. Investors may also use the term to refer to an evaluation of an investment's potential return in relation to its cost and its risk. Many companies use a combination of debt and equity to finance a business expansion. For such companies, the overall cost of capital is derived from the weighted average cost, WACC, of all capital sources. This is known as weighted average cost of capital. Weighted average cost of capital, let's talk about this one in details. A firm's cost of capital is typically calculated using the weighted average cost of capital formula that considers the cost of debt and the cost of equity capital. There are two cost of capital. One is the cost of debt, another one is the cost of equity. Each category of the firm's capital is weighted proportionately to arrive at a blended rate, and the formula considers every type of debt and equity on the company's balance sheet. Balance sheet is the sheet that will be prepared by considering all the credits value and all the debit values, and it will be equal. So including the common and preferred stock, bonds, and other forms of debt. So this is the cost of capital, okay? Cost of capital. Number two is the cost of debt. The cost of capital becomes a factor in deciding whether financing track to follow debt, equity, or a combination of the two. Early stage companies rarely have sizable assets to place as collateral for loans. So equity financing becomes the default mode of funding. Less established companies with limited operating histories will pay a higher cost for capital than older companies with solid track records, since lenders and investors will demand a higher risk premium for the former. So the cost of debt is merely the interest rate paid by the company on its debt. So it's a expenditure. However, since interest expenses is a tax deductible, the debt is calculated on an after-tax basis as follows. Cost of debt equal to interest expenses divided by total debt into 1 minus capital T, where interest expense means interest paid on the firm's current debt. Capital T is the company's marginal tax rate. So the cost of debt can also be estimated by adding a credit spread to the risk-free rate and multiplying the result by 1 minus T. So cost of debt equal to interest expense divided by total debt into 1 minus capital T. Now the cost of equity. First is the cost of debt. Then second one is the cost of equity. There are two terms. One in the cost of capital. One is the cost of debt. Another one is the cost of equity. Is more complicated since the rate of return demanded by equity investors is not as clearly defined as it is by lenders. The cost of equity is approximated by the capital assets pricing model, CAPM, capital asset pricing model. So cost of equity equal to RF plus beta RM minus RF. So RF is the risk-free rate of return. RF is the market rate of return. Okay. So this is the cost of equity. This is the RF plus beta RM minus F. Beta is used in the capital asset pricing model formula to estimate risk, and the formula would require a public company's own stock beta. For private companies, a beta is estimated based on the average beta among a group of similar public companies. Let's have an example later on. The firm's overall cost of capital is based on the weighted average of the cost of capital. For example, consider an enterprise with a capital structure consisting of 70% equity and 30% debt. These two value is the cost of capital. Okay. Equity is 70%, debt is 30%. Its cost of equity is 10%, and the after-tax cost of that is 7%. Okay. Therefore, its WSEC would be, that is no 70% equity. And based on the 70%, the cost of equity is 10%. So 0.7 into 10% plus, because WSEC is the cost of capital. Okay. We have to calculate the cost of capital by considering cost of equity and cost of debt. Both will be given. Okay. And cost, as it is a 30% debt, so 0.3, and the cost of that is 7%. So 0.3 into 7. So total value is, I think, 9.1%. If you calculate it, you'll get it. So by this way, we can calculate the weighted average cost of capital. So cost of capital is a term that contains the cost of equity and cost of debt. Another term is the cost of equity capital. Although debt and prepared stock are contractual obligations that have easily determined cost, it is not easy to measure the cost of equity. In principle, the cost of equity capital involves an opportunity cost. As it is a capital, so it is an opportunity. In fact, the firm's after-tax cash flows belongs to the stakeholders. Management may either pay out these earnings in the form of dividends or retain the earnings and reinvest them in the business. Okay. As the cost of equity, you have gained some money in your business. You have earned some money in your business. You can distribute this money to your investors. One cases. Second cases, you may retain your monies in the bank. Second case. Third case maybe you can reinvest them in new business, or you can reinvest this capital earnings in the similar business or in the existing business. So this is the capital. Therefore, the firm should earn on its retained earnings at least as much as the stockholders themselves could earn in alternative but comparable investments. If a firm cannot invest retained earnings so as to earn at least the rate of return on equity, it should pay these funds to these stakeholders and let them invest directly in other assets that do not provide this return. Okay. This one maybe you can reinvest. In general, the expected return on any risky asset is composed of the three factors. One is the expected return on risky assets. Carefully mind it. Expected return on risky asset. Some money will be returned, and on the risky asset, there are three terms. One is the risk-free interest rate plus inflation premium plus risk premium. Okay. Sometime in the market, there will be some inflation, or sometime in the market, there will be some risk. So these three terms, when you sum up, you will get the expected return or expected income. This equation says that the owner of a risky asset should expect to earn a return from three sources. Compensation from the opportunity cost incurred in holding the asset. This is the risk-free interest rate. Number two is the inflation premium. Compensation for the declining purchasing power of the investments over time, known as the inflation premium. Number three, risk premium. Compensation for bearing risks, known as the risk premium. Okay. Now, fortunately, you do not need to treat the first two terms as separate factors, because together they equal the expected return on default-free bonds such as government bond. Okay. Sometimes these two things will be governed, will be organized by the government, will be declared by the government. That's why sometime in the USA you'll see these two terms will become one. Interest rate on a government bond plus risk premium. So owners of the government bonds expect a return from the first two sources, but not the third. So we can simplify the previous equation, this one. When investors are contemplating buying a farm's stock, they have two primary things in mind. One is the cash dividends and the gains or share appreciation at the time of the sale. From a conceptual standpoint, investors determine market values of stocks by discounting expected future dividends at a rate that takes into account any future growth. So the cost of equity is the risk-free interest rate plus a premium for taking a risk as to whether a return will be received. This premium is multiplied by beta. Okay, multiplied by beta is the approximate measure of a stock price volatility. Beta quantifies risk by measuring one firm's stock price relative to all of the market stock price as a whole. Let's have an example here. If beta is greater than 1, it means that on average, the stock is more volatile than the market. If beta is less than 1, it means that on average, the stock is less volatile than the market. W for beta are commonly found for most publicly traded stock in various sources. Source is below line 6. The cost of equity is quantified as IE, cost of equity equal to RF is the return plus beta M, RM minus RF that I said previously. RF is the risk-free interest rate, commonly referred to as US Treasury bond yield, inflation adjusted here, plus and the risk premium. Maybe this example I will conclude. If you carefully look at the example, you will understand what I said in previous. Okay. Determine the cost of equity. Capstone Corporation needs to raise $55 million for the microchips, micro CSP project described in example 11.1. Capstone's target capital structure calls for a debt ratio of 0.4, indicating that 33 million has to be financed from the equity. The pertinent information is as follows. Capstone is planning to raise. Is there anything? Capstone is planning to raise $33 million from the financial markets. So Capstone's beta is known to be 2. Beta is given 2, is the little volatile, which is higher than 1, indicating that the firm is perceived to be riskier than the market average. The risk-free interest rate is 5.47% and the average market return is 13%. These interest rates are adjusted to reflect inflation in the economy. The micro CSP project is a normal risky project comparable to the firm's market risk. Determine the cost of equity to finance the plant modernizations. Okay, Capstone Corporation, they wants to finance the plant modernizations. This dissecting the problem. What is the given here? RM is 13%. You see, average market return is the 13%. RM is the average market return is 13% is given. Risk-free interest 5.47%. RF is given. Beta is 2. What is IE? Cost of equity. Compute IE. We calculate IE as follows. So formula, you know, IE equal to RF plus beta, RM minus RF. More previously, if you go here, okay. Yes. This beta into IE minus RF. Okay. This one, IE equal to RF plus beta, RM minus RF. Very simple. If you put the value, you'll get is the cost of equity is 20.53%. What does this 20.53% represent? If Capstone finances the project entirely from its equity funds, the project must earn at least 20.353% return on the investments to be worthwhile, assuming that the project risk is about the same as the average risk of the company's assets and operation. And okay.
আর এই পর্যন্তই থাক স্যার।
ওকে, আজকে পর্যন্ত থাক। আমরা মোটামুটি ম্যাথসটা শেষ করলাম, এটা 58 পেজ। এখন আমার মনে হয় তোমাদের কুইকলি একটু অ্যাটেন্ডেন্সটা করি, কল করি। সবাই আসো নাই কে কে?
স্যার মনে হয় সবাই আছি স্যার।